Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined by two of my colleagues, but not the two you might expect. Chris and Marisa Di Natale, my typical co-hosts, are AWOL, and I've got two other colleagues. Thank you for joining, Dante D'Antonio and Matt Collier. Good to see you,
Hi,
Collier.
Mark.
Collier. Got that right, Matt?
I
Didn't
would
I?
say so. Yeah, that was
Yeah.
better, above average.
Above average, above that, quite not quite there yet, but a little bit better than average. That's good. Okay, it's good to see you guys,
Good to
You
see you
too.
too.
and thanks for stepping in. We had to do this. This is Saturday morning, June the 8th, so the day after Jobs Friday. We typically record this on the Friday, but I was at the CBO Congressional Budget Office yesterday. My favorite day of the year.
How did that go?
It's really cool. There's a panel of advisors, economic advisors, that provide advice to CBO. And actually, this happens twice a year. They get together, the economists and CBO staff get together and discuss issues that are critical to the CBO work and forecast. And so, very interesting topics. All very practical. The CBO, because they're forecasting, right? The economy and the budget. Just for everybody's who doesn't know, the CBO is the non-partisan group that does the budgeting for the budget forecast for the U.S. And they have to do an economic forecast, right? So they have the same issues, problems that we have in our work, and so it's very, very relevant, and very much enjoy. And the other economists there are, pretty cool. They're a lot of very high-powered academicians and practitioners, and it's really a really cool day. But it's an all-encompassing day. I couldn't break away and do the Inside Economics podcast, so
We'll
that's why
forgive
we're
you.
here Saturday morning. Last week was also we had our conference, right, Dante? You were there.
I was, yeah. Thought it went
Yeah,
really well.
and you were mano a mano with Cris on productivity.
That's right.
Who
Much.
who I missed the session. Well, who won?
I think we both tried to claim victory at the end, so I'm not really sure that there was a clear consensus on who won. I think we both felt pretty good about our arguments.
Yeah, and that's the problem with productivity. You can argue both sides of that one pretty easily, right?
That's right.
Strong, weak, so forth and so on. But you were the skeptic.
I am the productivity skeptic of the group. Yeah.
Yeah, right. And Cris is the optimist. So I'm sorry I missed that. But you're gonna do it again.
Are we?
Yeah. Oh, you didn't know? Yeah, we've got two more conferences. One in Southern California, I think Irvine, and Chicago later in the year. I'm not sure exactly when, but we're
Gives
going to
me
reprise the DC conference this past week.
gives me a chance to refine my argument.
Exactly. Exactly. You get another data point or two.
There we go.
And those productivity numbers have been on your side like most recently, right?
Yeah, they haven't looked great recently, so we'll see what Q2 looks like when it comes out.
Yeah. Okay. All right. Very good. Okay. Well, the big news obviously is the jobs report, right?
Yeah.
And Dante, do you want to just start us off here? Or what do you think of the report?
Sure. I think it's a good report. In terms of top line job growth, obviously very strong, stronger than expectations. So we're sort of back in that pattern that we had in the first quarter of the year, where job growth is coming in a little bit hotter than people expect. Certainly, there are some holes in the report that we can talk about and discuss. But in terms of job growth, the broad based, more so than it has been in recent months. Still healthcare sort of leading the way in terms of job gains, but you've got leisure and hospitality that picked back up again, public sector hiring picked back up again. Professional business services had its strongest month of job growth in a while, so all those contributed to the 272,000 headline job number. Still averaging right around 250,000 over the last 3 months, which has been pretty stable. Even if you go back a year ago, that 3 month average is basically the same as it was a year ago. So we've had some ups and downs over the last 12 months, but trend job growth looks like it really has not moved a whole lot over the last year. Revisions were pretty small, not anything to really be concerned about this month. Wage growth maybe is one thing that gets people a little bit concerned. I think we had a good month last month. Wages were only up 0.2% over the month. In May, that doubled. They were up 0.4%. brings year-over-year wage growth back just above 4%, 4.1% on a year-over-year basis. Again, I don't know that that's anything to be, super concerned about at this moment, but certainly a little bit stronger than I think we'd like to see. Weekly hours held steady, which I think is, probably good in this context. We've seen it deteriorate a little bit over the last 6 to 12 months, and so, I think holding steady or improving slightly is good at this point. The big unknown again comes from the household survey, where it looks
Before
like
you move
you're.
on to the household
Yeah,
survey, I mean, so you've been focused on the establishment survey, the survey of businesses,
yeah,
and lots of jobs, surprising number of jobs.
yep,
And it sounded like you said underlying job growth, abstracting from the monthly vagaries of the data, is about 250K. Is that right?
that's right. Yeah.
Yeah, that if you had asked me, a year ago, 5 years ago, 10 years ago, what job growth, sustainable job growth, underlying job growth would be today, I might have said 50K or 100K, not 250K.
Agreed. Yeah, and I think obviously there's a different dynamic at play on the supply side of the market, I think, than we would have expected those years ago. Where certainly I think immigration is helping fuel the supply side of the labor market more so than we would have thought, and allowing for job growth to stay this strong with the unemployment rate, holding steady and actually edging a little bit higher here over the last couple months.
Oh, so what you're saying is that we can sustain this pace of job growth at least for as long as immigration remains as strong as it is. So we've got all these folks streaming across the border. They're getting authorization to work. They're going to work. That's showing up on the payrolls of businesses in the numbers we're seeing. So the fact that we're creating this many jobs isn't, it's a good thing. And it's not a problem because we've got plenty of labor supply because of the immigration that we're experiencing.
Yeah, I think so. I mean, we haven't, again, we're seeing that level of job growth without seeing the unemployment rate move lower, without, wage growth
Actually
was a little.
moving up, right?
Right, actually moving up. Wage growth was a little bit hot this month, but that's not a trend at this point. So, it seems like we're able to generate that level of job growth without pushing wage growth higher, without the unemployment rate, without the labor market getting tighter, essentially. So that's a good sign.
Yeah. Before we move on to the household survey, Matt, maybe I'll bring you into the conversation. What do you think of that kind of diagnosis or description of the payroll survey and what's going on there?
I think that's all the main points. I think
Okay.
the 250K underlying job growth being, surprising, we can sustain that and see the unemployment rate tick up. But like we're mentioning, so just as surprising is the level of immigration that's pulled that whole level up.
Right. Right. Okay. Okay, but the report is schizophrenic. The jobs report is schizophrenic, right? Because as you were just going about to say about the house, so there's the establishment survey, and then there's this survey of households, which is the basis for the unemployment rate. And as part of that, the Bureau of Labor Statistics estimates jobs and labor force, and that's telling a very different story, right, Dante?
It is, yeah. I mean, the size of the labor force fell. The number of people employed, as measured by the household survey, fell by just over 400,000 compared to a gain of 272,000 in the payroll survey. The result of that dynamic is that the unemployment rate ticked slightly higher to 4%. Right, that's the first time we've hit that 4% threshold since January of 2022, I believe. So we'd been sub 4% for more than 2 years at this point. And again, it feels like you're reading a different report when you look at the household survey compared to the payroll survey. Again, it's not, I don't think, flashing that a recession is dead ahead, right, with unemployment at 4%, but it's certainly weaker than the payroll survey in terms of what it's signaling about the labor market.
Okay, so why? I mean, the payroll survey saying great guns, we're creating a boatload of jobs. A household survey saying not so much. That's not happening. Where's the immigration effects in the household survey?
Yeah, I mean, I think we've touched on it a little bit before, but yeah, I mean, I think the immigration effects are harder to pick up in the household survey, right? The household survey is benchmarked to, or the population controls that are used are based on Census Bureau estimates of the population at that time. We know that the Census Bureau estimates of population are severely undercounting immigration today. And so, we're sort of controlling that survey to a level of population that's probably not accurate, which is, essentially pulling down those estimates from what they could be. Um, Again, that the effect of that probably has, minimal impact on the unemployment rate, because if you're, sort of misrepresenting the size of the labor force and the number of people employed and the unemployment rate all to a similar degree, it shouldn't have a huge effect on the sort of calculated rates that we get. And I think that's part of why we haven't seen the unemployment rate drastically start shifting around as a result of this. But it gives you these, sort of wacky looking results in terms of, how are we adding 272,000 jobs, but the labor force is actually getting smaller, and the employment that we're measuring in the household survey is falling by more than 400,000. You get some of those, sort of strange results in level terms, but the unemployment rate still looks pretty good.
Yeah. So just to reinforce what you're saying the household survey actually isn't picking up the immigration, because ultimately that survey is, let's call it, benchmark to actual population estimates. Those population estimates are coming from the census, and the census hasn't incorporated the surge in immigration that we've seen over the last couple, 3 years into their numbers. Therefore, they're understating population, labor force, and therefore what's going on with jobs based on the household survey. There may be other things going on in terms of survey responses by immigrants, although I've heard that argued on both sides. I mean, one argument is these immigrants, they're asylum seekers, are going to be nervous about talking to government survey takers. They don't want to participate. Although I've also heard the other argument that they do have a court date. They're here in the country. They're in the country, and they don't want to run afoul of the government. Therefore, if a statistician knocks on the door, so to speak, that they're going to respond, because they don't want to run askew to a government statistical you know what I mean. Yes.
Right.
It's Saturday morning. I'm having a hard time getting my words out. I have had my coffee, but I haven't had my cereal yet. So, but you get my drift. Is that so? It feels like the real problem here is the population counts, not the survey responses.
Yeah, I would agree. And I mean, I think if anything, it's probably, they're less likely to be picked up in the survey in the first place. So whether or not they would answer the questions or not, I don't know that it matters a whole lot. I think they're less likely to be, picked up just because they're just recently into the country. Until you sort of work your way through that process and can be sampled into the survey, you're just less likely to get talked to in the first place. And so we know that the immigrants coming in have a strong proclivity to work, and so if you're not capturing sort of that dynamic of them going to work pretty quickly, it's going to weigh on some of those labor force and employment numbers as well.
Yeah. Okay. Matt, anything to add on the household survey?
Dante, I think you've looked at it. The 16 to 24-year-olds, they're just getting out of college, and there was a really wacky number there that I think explains a lot of that decline.
Decline in what?
The household employment number. So the minus for 58. I guess that's the adjusted to CES measure. But
hold on, now you're saying a lot of things that no one understands.
You're right.
So you're saying household employment fell,
and
you're saying one thing we have to consider is that the household employment definition is not the same as the payroll. And if you make a correction to put it to apples, did the household employment number also fall if I put it on a payroll survey based definition?
It did. So
okay, and you're saying that fell largely because of a decline in the number of young people working.
Yes, and to an unusual degree. I mean, there's a lot of seasonal stuff going on, as you could probably guess. It's May. Kids are graduating college, high school, picking up jobs, and it was kind of a strength in March and April, almost as if those jobs started earlier. So now in May, when you're expecting a lot, there was not. So there's this huge adjustment negatively to kind of smooth things out over the course of a year. And that explains most of the decline in the household survey. I don't know if you have a difference of opinion there, Dante, but that's how I saw it.
No, yeah, if you look at just prime age workers, right? If you look at just 25 to 54-year-olds, employment in the household survey actually rose. The labor force actually grew slightly for that group. So, if you sort of take out the more volatile 16 to 24 group, and then you take out the sort of more volatile 55 and over group in terms of movements in the labor force, that prime age group looks much better, right? They're working more, they're more likely to be in the labor force than they were a month ago. So I think that that negative number on the labor force and employment is a little bit skewed by what's going on in the sort of youngest and older workers this month.
Okay. Okay. All right. But let's take a step back because we've been in the weeds, down into the bowels of these numbers. Let's just take a step back. If I look at more broadly at the labor market data, I'm not really sure what to make of it. I mean, the top line is that monthly payroll employment gain, the 250,000 per month. Okay, you look at that, you go, everything feels fine. The economy's resilient, strong, creating a lot of jobs. As you pointed out, it's broad based across industry. That all feels pretty good. And then one other point, if you take the job growth and the growth in wages, average hourly earnings, that does suggest a lot of income being generated. And that income obviously is the fodder for consumers to continue to spend, which has been the key engine of growth. So that the fuel for that growth seems to be in place. No problem there. But then if I look at kind of other labor market indicators, I don't feel quite as sanguine. Like, hiring rates are way off from where they were a year or two ago. And just anecdotally talking to, people in my world, young people in my world looking for work, it's not easy. They're struggling. Feels like they're struggling a little bit to find jobs. If I look at and that goes to unfilled positions, they're elevated, but they've come down a lot and they seem to be falling pretty fast here. Quit rates are down, temp jobs are down, hours worked are down. Everything you look at, except for the job creation, which goes back to the low. I guess the positive is layoffs are still low, but the other kind of dynamics in the labor market, kind of looking under the hood, don't feel particularly good. So how do you add that all up, Dante, in your thinking?
Yeah, I saw somebody with a similar sentiment, I think yesterday when I was reading, that said it's a great labor market if you're already in it, but it's not a great labor market if you're trying to get into it, right? So if you're looking for a job, it's not particularly good because, as you alluded to, there's definitely some softening in terms of the demand side of the market, right? We've seen job openings, whether we believe the job openings level or not, there's a pretty clear trend there that, job openings have come in a lot over the last 18 months or so. I think it's pretty clear that firms are, sort of less interested in hiring today than they were 12, 18 months ago. And so I think the dynamics there are not great. I think it's a question of whether hiring continues to slow, right? Whether this is sustainable, right? Depends on whether hiring sort of holds at where it is. And it's been roughly stable now for about 6 months. There's a little bit of volatility month to month, but
Right.
the big decline in hiring looks like it's over. And so, if that sort of holds up, we can maintain current level of job growth. The level of layoffs is still very, very low. Again, a little bit of volatility week to week, month to month, but I don't think anyone has any major concerns on the layoff side of the equation. So it's really a question of, is there enough appetite among firms to keep hiring given, sort of this decreasing level of job openings? And excuse me, will that continue to hold up? I still think so. I think, to me, the risk is still stronger that the labor market starts overheating again, and it sort of falls off the rails here.
Really? Okay.
Yeah, I think marginally, at least based on this last report, has me a little bit more concerned. I'd rather see job growth at 200,000 and sort of be sure that wage growth is settling in. And I think it's pretty clear that job growth right now is stronger than that and is doesn't look like it's slowing down anytime soon.
I'm curious, Matt. Do you have a similar sentiment? The concern being so right now the job market is doing what we need it to do. It's creating a lot of jobs. and it's creating a lot of income. Concern is, well, is it weakening from here, like I was uh, articulating, or to Dante's view, it's the risk is that it reaccelerates and it reignites inflationary pressures. Do you have a perspective on that, Matt?
I think the number of data points in your bucket there that are looking
Yeah.
soft is growing. I don't think I panic until I see weekly unemployment claims for unemployment insurance start to hover around 230, 240 on an
They were
average.
229 last week, Matt.
I saw it, but it's been
Okay.
it hasn't has there been consecutive weeks, Dante, as
Okay. All
an
right.
astute
1 week
writer.
doesn't a trend make.
I
Yes.
need
Okay.
trend closer to 240
Yeah. Okay.
in that range to say, okay, that is a plateau that we weren't at for a long time. So until I wouldn't say I'm as afraid of a reacceleration as Dante said, but I'm not totally confident that we're on a downward slope as much as a plateau for the time being. And that also means wage growth isn't going to slow. So maybe that puts me in the middle between you two.
Okay. Yeah. The other thing on layoffs, and I think it really does boil down to layoffs, right? I mean, you're right. If we maintain hiring rates where they are and layoffs where they are, we're going to continue to create a lot of jobs. But on the layoffs, uh, it's confusing to me, or it's not satisfying to me, the explanation for why layoffs are so low. We're saying, at least the prevailing theory I've heard, and I haven't heard a better one, is that because businesses have struggled with a very tight labor market, more or less, for a long time, pre-pandemic, during the pandemic, post-pandemic, they're loath to lay off, because if they lay off and get wrong-footed, demand improves and they need to hire people again, that, they're going to scramble. They're not going to find the workers they need. So therefore, they're not going to lay off at this point in time. That's the so-called labor hoarding kind of argument. That feels okay, maybe, but that feels like a pretty tenuous kind of explanation. And even if it's true, it feels pretty tenuous that businesses are going to hold on to that for very long if demand starts to weaken. No, Dante?
Yeah, I agree. I mean, I think to me, it seems like kind of a strange argument. That can't be everything that's happening right now. It's not like every firm would start laying people off if they weren't worried about being able to rehire workers. I mean, the economy is still strong today, right? I mean, we're still adding jobs at a pretty good pace. So there's still firms are still looking to bring more people on. So it's not, I think that there's some segment of firms out there that likely would reduce headcount today if it weren't for concerns about being able to rehire people. But I don't think that's the sort of prevailing reason why layoffs are low, right? I think layoffs are low because the economy is still strong and firms still need
You're saying demand's
workers.
strong enough to make to
Yeah, I think
yeah,
that labor hoarding is a part of it. I think it's a small
yeah.
part right now. And yeah, to your point, I don't if
But
that
the
was the
layoffs are
argument.
extraordinarily low. I mean, they have been extraordinary. I mean, lower than you would expect in a kind of a typical well-functioning economy, right?
Right. I mean, I think, more recently jobless claims have risen, but claims
Yeah.
had been at, say
200.
210,000.
Yeah,
That's very low. So maybe labor hoarding explains why they
I
were
see.
at
Okay.
210 instead of 230
I
over the
see.
last couple of months.
Okay.
So, to me, it's like, okay, well, if firms stop doing that, if they stop hoarding labor, layoffs pick up a little bit, but I don't think the labor market falls apart if they all of a sudden decide to stop doing that. I don't think that's enough to derail the whole thing at this point.
Yeah.
Doesn't
Okay.
feel like it.
Yeah, the other thing I worry about is, being part of a large multinational organization that does a lot of hiring. It feels like businesses are looking to each other for signals as to what they should be doing, around payrolls. If one company decides to start laying off, then it feels like uh, others follow suit pretty quickly. They're all kind of looking at each other, and it just feels like we can go from low number of layoffs to somewhat higher and then high layoffs pretty quickly. It just feels pretty tenuous to me.
Yeah, I mean, I think we saw an example of that in tech early last year when you had a
Yeah,
sort of wave of
that's a
tech layoffs, and
great example.
it was
Yep.
contained within tech, so it didn't have a huge impact. But if that starts to sort of broaden out across industries, then it could create a problem.
Yeah. Okay.
Yeah, I think if you square that with consumer business sentiment, how negative everything has pretty consistently been, that I think that aligns nicely too. Of okay, the sky is falling as we expected it to, and I think everybody runs at the same time in a kind of brittle way. So I'm curious how we ever respond to a negative jobs report, say, even if it gets revised away. I've always kind of thought about that. But
Yeah.
yeah.
Well, here's the other thing that, you know, it kind of adds to the angst. The rise in the unemployment rate. There's that old kind of rule of thumb. If it rises by what, more than a half
Half.
a half a percentage point, from its low in a period of a year. So if you go back over the past year and the unemployment rate's up a half a point or more in that period, and I might be butchering that a little bit, but that's kind of roughly right. That you get into this very kind of to Matt's point, self-reinforcing negative kind of cycle. The higher unemployment causes people to lose some confidence. They start to pull back on their spending. That causes a weakening in demand. Then businesses start to lay off a little bit more, and you kind of can see how you can get into this kind of self-reinforcing cycle. And historically, when the unemployment rate rises by more than half a point within a year from the low, you go into recession. And we're at 4. I think the low was 3.5, wasn't it? About a year ago. So I haven't looked, but on a year-over-year basis, we might be up about a half a point. No?
The SOM rule you're referring to,
Yeah.
but it's the 3-month moving average. So
Oh, 3-month moving
so
average.
we're
Okay.
close. I think we're 0.37 up from the 3-month moving average low of about a year ago,
So
which is
we get this monthly data on
Mhm.
unemployment. You take a 3-month moving average of it.
Right.
Then you look at the unemployment rate today compared to its low point, and you're saying it's up 0.37,
That's right.
not 0.5.
Close, but yeah, and
Close.
it starts to rise. So we can afford a little bit and a little bit more slow increases in the unemployment rate without hitting that threshold.
Right.
But Claudia Sam, who invented the rule, has also kind of stepped back from it, as in like, hey, it's not surefire. It's just been historically true. So there's some reasons to be a little bit,
Yeah, that's like, okay, fair
yeah,
enough. That's the
right,
true. That's by definition true.
sure.
So yeah. But Dante, any reason we should be worried about that? Or is that just goes back to your point about squirrely kind of numbers related to young people going from school ending and going to work, that kind of thing?
Yeah, I mean, I wouldn't say we should be totally unconcerned, if only because the average consumer, the unemployment rate might be the only thing they see in terms of labor market performance, and they're not thinking about the technicalities behind why it's going up. So if I'm sitting there and I'm seeing the unemployment rate creep higher month over month, and I'm just sort of the average consumer out there, that might start to concern me if I'm not consuming other information about the economy. I would say, sort of offsetting that is that I would have to go back and check. But historically, I would think when we're starting to trigger that half a percentage point increase, we're not typically doing it when we're also creating 250,000 jobs a month, right? So if you're at least consuming 2 data points, you see the unemployment rate going up, but you also see that lots of people are still getting jobs every month. I think that sort of takes away some of the sting and some of the concern that creates.
Mm.
So if you're talking about, me sitting here, I'm not concerned about it at all. I would say I'm a little concerned just from the psychology of it, of, if that's the only thing consumers see, kind of like gas prices, right? Consumers are
Mhm.
digesting a couple of data points that just sort of matter to them about the economy. And if the unemployment rate's sort of the big thing they see about the labor market, and it continues to creep a little bit higher here over the next, the second half of the year, as I think, expect it to, I think that might, create a little bit of concern amongst people. And again, I think we're in a sort of fragile enough state where, any other bad news is not going to help in terms of consumer spending and consumer confidence.
Yeah. Of course, I'm thinking of all this in the context of the 5.5% federal funds rate target, with the Federal Reserve putting its foot flat on the brakes here. Just feels like to me, and I wrote an op-ed in the Washington Post this past week with Jim Parrott, a good friend and good researcher at the Urban Institute, arguing that the Fed has achieved its targets of full employment and inflation at the 2%. If you have to read the piece. I won't go into detail, but one of the arguments I was making, or one of the points I made, was that the labor market feels a little fragile, and in kind of, if the funds rate target was kind of closer to its equilibrium, meaning it's not restraining economic growth, I'd be less concerned. But when you have a 5.5% funds rate target, that's a pretty high interest rate. Yield curve is still inverted. Short rates are still higher than long rates. And in that kind of world, given all the other things that are going on in the labor market, it just feels like this is the time to start cutting interest rates. At least start slowly, see what's going on.
Yeah. Do you, not that if you don't want to get into it now, we can wait, but do you think, the Bank of Canada and ECB cut it, now that we're starting to see some cuts globally, do you think that plays into the Fed's decision making at all, or do you think they completely ignore it?
I think it's kind of on the periphery. I don't think they have a so-called reaction function, where they're looking at lots of stuff, inflation relative to target, unemployment relative to full employment, financial conditions, so forth and so on. But going back to businesses, look at other businesses when making decisions about their payrolls. I think central banks look at other central banks, in part because they have to, particularly if you're not the United States, because if you're falling out of step with each other, then currency markets start to get more volatile and problematic, and you have other kinds of balance of payment issues. So, but in this case, it's the differences are it might be a matter of months before the Fed starts cutting interest rates. So I don't think so. But all else being equal, yeah, I mean, they must be looking at what the ECB did, the European Central Bank and the Bank of Canada did. They cut rates, and I think that very good policy. I think that's the appropriate policy, and that they should follow that here. So I worry about the labor. Yeah, the labor market's resilient. It's done a great job navigating things so far, but the longer you keep rates as high as they are, at some point things start to break, and just feels like the labor market's a lot more wobbly than the 250,000 in underlying monthly job growth would suggest. Just a view.
Yeah.
But I highly recommend the Washington Post op-ed. Folks should go read that. Okay, we're going to come back and talk about the inflation numbers that are coming out in this coming week, and of course the Fed meets this week, so we can talk a little bit about that. But before we do that, we're going to play the game. You guys up for that? We don't have Marisa, so maybe someone else is going to be able to win here. So, and the game is, we each pick a stat. The rest of the group tries to figure it out through cues and questions, deductive reasoning. The best stat is one that we don't get quickly. It's so easy we get it quickly. One that's not so hard, we never get it. And if it's apropos to the topic at hand, that's all the better. So, Matt, you want to go first?
Let's do it. 2.3%.
In the jobs numbers?
No.
Is it an economic release?
Yes.
This week? This past week?
Yes.
Is it our current estimate of GDP for the second quarter?
No.
No. Okay.
That's 1.9.
Yeah, it's 1.9.
For the
You're close to
for
that.
the record, yeah, you're close, but just for
2.3.
2.3%. What else came out this week? I've been so busy with conferences and CBO, and is it inflation related? Is it jobs related?
both in an ancillary way, tertiary relationship.
So it's neither.
Neither.
Is it a growth rate?
Yes.
Is it a year-over-year growth rate?
Yes.
Is it productivity related?
Yes.
Productivity growth.
Productivity
for the
growth.
last year.
Over the last year, I used a 4-quarter moving average, but if you guys got this close. So I know Dante's the long term.
Well, I think I got that. He kind of snuck in there in a kind of a slightly rudish way.
He
see how
I
he
tied
gotta-
did that?
I'll take whatever I
tied.
can get.
Yeah,
Deviating outside of the jobs
man.
report, I'm struggling here.
I took him all the way to the finish line, and
That's
he
right.
put his nose in front of me.
That's
You see
Marissa's
that?
not here, so I gotta make sure I sneak
Oh
in there and
gosh,
do
that's
right by her.
rude. Okay, all right. All right, sorry, Matt. Go ahead and explain.
Dante's the doomsayer when it comes to productivity, I know, but the 2.3% growth, that's over 4 quarters. It's a volatile series. It's not it changes quite a bit. But if we could sustain 2% productivity growth, I think that's as important of an economic indicator as you can get. But apropos to right now, the Fed says that wages can grow 3.5%,
No,
and
the Fed doesn't say that, do they?
they
That's what
estimate.
everyone else says.
Oh, I've always attributed it to the Fed. Is this slander?
I don't think they've actually said that, have they, Dante? I don't know.
Uh,
That's kind of the conventional wisdom. I don't know. Yeah.
I feel like I can picture Powell saying that. So if I'm wrong,
Okay. All
he'll
right.
have to forgive me. But
I don't know.
he could be
It doesn't
he could
sound
be
like something
parroting
the Fed would say, though.
he could be parroting
Okay.
what everybody else says. But the 3.5% rule of thumb wage growth is compatible with 2% inflation because the difference is made up in productivity growth. So not all of that 3.5% wage increase would be passed through to consumers. So goes the thinking. So one way I think that, or if wage growth does plateau, it's a little over 4% right now. One way that could become compatible with 2% inflation, the Fed's inflation target, is if productivity growth picked up. I'm more optimistic than Dante. I'm more in Chris's camp. I think there's more reasons to be optimistic than there's pessimistic when it comes to
Picking a fight,
productivity.
Dante. This is the second time he's picked a fight.
Yeah.
Well, Chris isn't here, so he feels like he's got to defend his honor, I guess.
Sure.
I see.
Yeah. And I look for any chance I can to go at Dante. So I think it's a really important figure. I think long term that could be sustained for a lot of reasons. And I'm also less optimistic about wage growth. I think there's a chance that it does plateau where it is today. I think it's moved sideways for a bit.
When you say less optimistic, what does that mean?
The labor market's going to continue to loosen and pay growth is going to slow further and further like we expect inflation to. I think we're kind of structurally tight, and I think 4% annual wage growth is reasonable to me. But so for that reason, I watched the productivity statistics closely, and I'm relatively encouraged in the long run.
Right. Dante, you want any retort there or anything you want to say?
No, I mean, I agree, right? I think given current productivity growth, right, I think wage growth is fine, right? I don't think there's any issue with wage growth today, given what we know about productivity growth recently. I think I have a question about whether that's sustainable and whether wage growth can, stay at 4% permanently, or whether productivity growth is going to, sort of loosen here a little bit over the next couple of years, and wage growth would have to come in a bit. But I don't think that matters so much for the current concerns around inflation, right? I don't think wage growth is inflationary right now. I don't think in the span of time between now and when the Fed decides to start cutting rates, I don't think wage growth is the thing that matters, right? And I think even they've made that, I think, pretty clear, where their focus has turned almost exclusively to inflation of late. They're certainly still watching the labor market, but I don't think their level of concern around the labor market is very small relative to how they sort of view inflation on a month-to-month basis. So yeah, I don't have any issue with wage growth. I don't disagree with Matt's take that I think we're in a good place in terms of how wage growth and productivity growth fit together right now. So
yeah, in that productivity and cost report, which is the basis for the number you're putting forward, there's also a compensation measure. It's another measure of kind of labor cost, and also unit labor cost, which is compensation per unit of output. So it accounts for compensation and productivity. And unit labor cost is kind of most critical to businesses' profit margins, which ultimately goes to their decisions around pricing. So if unit labor costs are rising, compensation is rising relative to productivity growth, then their profit margins are coming under pressure. They're much more likely to raise prices more aggressively. Inflation picks up. But the good news here is that on a year-over-year basis through the first quarter, and that's the data you're using, Matt, for productivity, unit labor costs were only up 1% on a year-over-year basis. Now, I hesitate to put too much weight on these even the year-over-year numbers, because they bounce around a lot, and they get revised too. So I don't want to put too much weight on it, but that gives me some solace, right? That labor costs are under control, therefore profit margins are going to be maintained, and if profit margins are maintained, less pressure on businesses to raise prices more aggressively. Does that all fit together for you, Dante?
Yeah, I think so.
Do you know, I haven't looked at this in a while, but that compensation measure that's in the productivity and cost report, how is that different from the other, like the employment cost index or the average hourly earnings or the other wage measures that we use? Have you looked at that at all?
I have
No.
not looked at it closely enough to know
Okay.
what
Matt,
the
have you?
specific difference is.
No,
Yeah.
me neither.
Okay.
Might be something good to take a look at, though.
Yeah, it'd be
Yeah.
good to look. I think it's a broader measure. It includes other forms of compensation other than obviously average hourly earnings and wages and salaries. ECI does as well, Employment Cost Index, but they try to account. I think they try to account for stock options and that kind of thing. All kinds of stuff. So it might be worth taking a look at that. Okay, that was a good one, Matt. Dante, what's your statistic?
Let's go with, which one should we use? Let's go with 83.6%.
Labor market related?
It's labor market related.
Household survey?
It is household survey.
Is it a participation rate? No.
It is a participation rate.
Oh, it is. Wow, that's a high participation rate. So it's a participation rate for some demographic group.
Correct.
And I'm right. That's a pretty high participation rate.
That's why I picked it.
Yeah. Because I think the overall fell a little bit to 62.5, which I'd like to talk about maybe after this. But so Matt, who has that kind of participation? I mean, white males between the ages of 45 and 46.
What's
It's a little broader than that.
Is it?
But it's kind of in that ballpark.
Prime age.
It's
EPOC.
There you go. It's prime age. Prime age labor force participation. So that's all. That's the only cut you need to make. Just prime age workers.
Oh, really?
83.6%.
That high for
That's
prime age. Yeah.
It actually ticked up a little bit this month. It's the highest of this cycle. It's the highest actually going back to, I think, 2000, either 2001 or 2002. And so it's another, the household survey looks sort of weak on its surface, but there are parts of it that look very strong, right? I mean, we're talking about an overwhelming amount of prime age workers that are wanting to work and at work, right? If you look at the prime age employment to population ratio, it's similarly high, right? It held steady this month. It's, I think, slightly off of its cycle high, but it's still.
Do you know what it was?
I think it was 80.8.
Yep,
maybe.
exactly.
Yeah. So it's a tick off
stuff,
of its.
Man, Dante knows his stuff, Matt.
I had an extra 12 hours to review this so,
he hasn't slept.
Okay, what was it? What was the EPOP for prime age a year ago?
Oh, a year ago? That I don't know. Slightly below that, I would assume. 80.5 maybe.
I think it was 80.6. I think
I'll take that. Close enough.
But you should be impressed by me. I was impressed by you, but I'm even more impressed by me.
Do I have to say it? Do I have to admit
Matt
to it?
knows it. Matt, come on, Matt. Wouldn't you agree?
I'm scrambling to verify this all.
Yeah, thank you. Let's fact check.
That's a good point. You better verify. He better verify, right? What is it?
You said 80.6.
80.6, May of 2023. Well, the thing that surprised the reason abstracting from the exact number, it's just been amazingly stable at a level that's just historically consistent with full employment, not more, not less, like right on the button. Pretty amazing.
It's actually 80.7 in.
Okay.
So it really hasn't moved much at all.
It really hasn't moved that much at all, right?
Yeah.
Yeah. Very interesting. But I digress. What were we talking about?
So
right. Prime age.
So despite some of the weakness in the household survey, a lot of it I think is just it's on the peripheral, right? It's young workers, it's older workers that are creating a lot of this noise and volatility month to month. Where if you look at prime age workers, participation, employment to population ratio, all of those are very strong and have been that way for a long time and not really signaling weakness at all. So I think it just sort of adds to that story around the labor market being strong.
That's actually a good way of looking at it, really. because it's the prime age is kind of the core of the labor market. That gives you a real sense of what's going on fundamentally, and then you got all this stuff going on for young people and older people, and that
Yeah,
kind of month moves around month to month because smaller groups, so forth and so on.
right. Not to say that those groups don't matter, but they're
Yeah,
smaller and they're much more seasonal in a lot of
more
cases. So it's
seasonal.
harder to
Yeah.
get an accurate read month to month. And so yeah, I think just sort of honing in on prime age makes things look a little bit better.
Okay. All right. All right. I've got one. And here you go. Two numbers. 2,756,000 and 216,000. I'll repeat, 2,756,000. I'm being obviously very precise. And the other is 216.
I gotta write them down just so I don't forget them.
Yeah, right.
So one is 2.76, the other is just 0.26.
I'll
You
start.
guys see what Matt does? He divides by 1,000. So, okay. Fair enough.
Are they labor market related? Let's
They're
start
labor
there.
market related.
This is jobs. Are they from the jobs report?
They're from the jobs report.
Okay.
Immigration related?
They're not directly. No.
Household survey related or payroll survey?
Both.
One from each. Is that where?
Yeah, there you go. There you go.
Oh, so to the 2.756 million, that's got to be jobs added based on the payroll survey over the last year,
Yeah.
probably. Okay. And then 216,000 is that jobs added in the household survey over the last year?
Based on the payroll
adjusted
survey.
concept.
Adjusted concept payroll survey.
So about 2.5 million apart. That's the.
Yeah, I mean, that's pretty amazing, pretty significant, right?
It's huge.
And I, if you go back last couple 3 years, that that gap has been steadily growing, and I it just reinforces the point about immigration. How significant the immigration effects have been. We think there have been other times historically when there's been a big gap between the household survey and the payroll survey. I think if you go back into the 1990s, and I don't know why that happened back in the 1990s, but so there there may be other things going on here, but it feels like the most likely explanation for why this gap between the payroll and household survey is the immigration, that the household survey is just not picking that up because they're using the census population counts that don't include the immigration, the surge in immigration. By the way, the surge in immigration has been so significant, and ultimately the question for us is, as forecasters, what happens next? I mean, the Congressional Budget Office estimates immigration last year was 3.3 million, right? Typically it's a million or so, a little over a million. That goes to the surge of immigrants coming across the border. And the question is, well, what's next? Are we going to stay at 3.3 million? Are we going to come back down to 1.1 million? Presumably we will at some point, but over what period of time? And that has enormous implications for everything. We've been talking about jobs, but think about what it means for, everything, housing and so forth and so on. So really, really pretty significant question, and something we're grappling with in our forecasting. Okay, very good. Why don't we turn back to so the conversation so far has been about what happened over the past week. Now let's talk about what's coming up in the coming week, because this is Saturday, and we've got the next key inflation report coming up is the Consumer Price Index for the month of May. And Matt, I know you've been doing a lot of work here trying to estimate what that report's going to say. You want to tell the group?
Yeah, so CPI, the Consumer Price Index, is always our first read on a month's inflation data. So on Wednesday next week, we'll get May's CPI report. We expect a 0.1% increase in headline inflation, which if it sounds low, it's because it is lower than recent months. And a lot of that is owed to moderating energy prices. So headline inflation includes energy and food, where core CPI does not. So if we are right, that would cause the annual headline inflation number, as measured by the CPI, to fall from 3.4 to 3.3%. And then ignoring food and energy, which in this particular month is a negative contribution. So core CPI, we have rising by 0.3% currently. That would pull the annual growth rate down a touch from 3.6 to 3.5 at its lowest in the post-pandemic inflation cycle. So a moderating report, and we're right at the rounding between 0.3 and 0.2. I probably could be persuaded, maybe, but that's maybe a different conversation.
But you're saying, because you sent me an email, and I'm very much focused on the second and third significant digit.
Sure.
For core CPI, excluding food and energy, for the month of May, you have that increasing 0.26 something, and therefore you round it up to 0.3.
That's right.
But 0.26, if you annualize that, you're close to what, 3%, something like that?
That feels right.
Is that right? Close to 3. And that's pretty close to Fed's target, right? I mean, because the Fed is targeting the consumer expenditure deflator, the PCE, so-called PCE deflator, and the target is 2%. And because of definitional and other factors, there's about a percentage point gap between the CPI and the PCE. So if we're at 3%-ish on the CPI, that would suggest we're close to the 2%-ish on the PCE. Or am I reading too much into it?
Of course, it would need to be sustained, but
yeah,
the logic, of course, yeah, I
0.26 is a pretty good number if we get 0.26.
Yeah, and I think that's where the little consensus other forecasts that we have, that's not out of range at all. I mean, I think that's the general expectation. So,
well, the consensus is what, 0.3?
0.3 as well, and you get less rounding data. So I don't know the second and third decimal points for a lot of stuff just yet. That stuff comes out closer to the report, but yeah, I mean, in general, there's 0.2s out there, there's 0.3s. I talked with our car guru, Mike Brisson, who's on top of all things auto related, about some of the stuff our model is spitting out. He is trying to talk me into used car prices being softer than we currently expect, but that's maybe a little too in the weeds.
He was trying to talk you into it being softer.
We've auctioned data from a couple months ago, the wholesale, like used car prices, what they were going for 2 months ago. Now they're on lots. Those are the prices that consumers pay. So we kind of look at this lagged effect, and then prices were flat a few months ago. So we're looking at pretty much flat growth in May, where Brisson is saying, no, used car prices are crashing, go low, go low. So I say,
oh, really? Oh,
yeah.
So you're saying the risk to your 0.26 is to the downside?
Yes.
Oh.
And especially since we're right there at 0.26.
And I've learned never to argue with Brisson.
I remember you said
apparently
that.
You've not learned that lesson.
No, I trust everybody from Western New York. So he is making a good case.
What does that mean?
We have Justin Begley.
What the hell does that mean? I trust everyone from Western New York. What, not Eastern New York?
No, I cut them off. But Justin Begley and Mike Brisson are two colleagues of mine that are from that part of the state.
From Western New York.
He's from Buffalo, yeah. So
it all fits now,
doesn't it? Yeah. So I say that any chance I get, I'd lump those two together in Western New York. But so yeah, the bias is low. Could be 0.2. I think that would be very encouraging. I don't think it puts a July rate cut on the table, but I think in line with our forecast of the first rate cut in September, that would be consistent with that.
Okay. Any other wild cards in the data, in the CPI number?
No, I mean, auto insurance has been up and down. It's mostly up. So yeah, it's very hard to know where that's going to be exactly. But I think, as with shelter, there's this incremental rolling over that we're expecting at least for auto insurance. That given what we know about vehicle prices, repairs, auto repair prices were flat in April. We expect kind of similar sideways movement now, and if that is the case, then that's a pretty strong source of relief for consumers. So probably one of the first 2 or 3 data points I'll be looking at when Wednesday's report comes out.
Yeah, of course, there's all the owner's equivalent rent, and you're just assuming that kind of continues to throttle back slowly over time.
Right.
Yeah, that's the cost of home ownership, the implicit cost of renting your own home if you were a homeowner, which is incredibly problematic. To my point in the Washington Post, go read the op-ed in the Washington Post. Pretty good, pretty good op-ed. I thought.
So too.
Did you read it, Matt?
I did. At the risk of spoiling the op-ed, I think the most persuasive case you put forward is you highlight all the wackiness with OER, the way that the government measures shelter inflation. So put that to the side, but the Fed is waiting on shelter inflation to come down, and until it does, they're going to keep interest rates high. But keeping interest rates high makes construction financing really hard, makes existing homeowners stay in their house. They have a 3% mortgage. If interest rates are really high, why move? So it's keeping supply really constrained. Really constrained supply is keeping prices higher, which is flowing back into government through rental prices. They're certainly related. Flowing back
keeping rents up too. It's keeping rents up because you can't build multifamily units. I mean,
right. And so to me, like that cyclical problem that you described, I thought was persuasive, and I hadn't seen it put so explicitly. And I think that's certainly the case. And I'm certainly a skeptic of OER.
Yeah.
I think then my contention would be that you suggest, okay, we should probably weigh OER less, and maybe the Fed should articulate why. Maybe
I say throw it out altogether.
I think
0.08.
And you give it you attribute it. You think it'll be a short-term credibility problem. I don't think. I think that wouldn't be the case. I think they can't move the goalposts. I think they can't give anybody.
I'm not saying change the target the PCE deflator. I'm just saying, like Powell, Chair Powell called out so-called super core service inflation. Said, hey, I'm looking at this because this really helps me decide what monetary policy should be. He's not changing the consumer expenditure deflator as the target, and I'm not arguing that either, at least not at this point in time, because I do get the credibility argument. But I'm saying, hey, instead of calling out this wacko super core service inflation, which by the way has got all this kind of imputed stuff that's meaningless anyway, because financial services costs are tied to the S&P 500. Does that make any sense? No. So why are we looking at that? Look at the so-called harmonized inflation measure, which is keep everything in, exclude the owner's equivalent rent, because we can't measure that, and it's all messed up. And no one else does in the rest of the world anyway, because they know it's all messed up. And therefore, if you do, it makes it a lot easier for them to start easing monetary policy and without losing any credibility. That's the argument. Anyway, you got me riled up all over again. But the Fed meets this week, and of course they're not. I mean, we're not expecting. Nobody's expecting them to cut rates now. I guess, is this the meeting where? I think this is the meeting where they released the new updated economic projections. So that'll be useful. Are you guys, Dante, are you expecting anything out of this? What do you expect? Any guidance here?
I mean, I don't expect anything to happen, obviously, in terms of rates. I am curious. I asked you earlier about, whether sort of other central banks moving will have any impact. So I'm curious to see if that enters into the conversation at all. I don't think they're going to explicitly, call it out as a reason to start moving, but I'm curious to see if that sort of shows up anywhere. To your point, I think it would be good if they at least started talking about, sort of a harmonized measure of inflation, excluding shelter, even if they're not moving the goalposts, they're not talking about a different target. But if you start, sort of conversationalizing that, hey, we're also looking at this measure without shelter because there are these known problems, so this gives us a sort of better read on what we think is really underlying price growth is. So it'd be nice. I don't know that that's something I would expect to happen in the next couple of meetings, but it'd be nice if they at least started talking about it a little bit more to get it out there. The thing to me is it feels like there's only downside risk here this week with the inflation report, right? It feels like report everyone's going to say, okay, great, that's what we want, but we need to see more, right? We had all these bad reports in the beginning of the year, so that, okay, that's one piece of good news. We need more good news. But if it's a bad report, the sky is falling. A rate cut in September might get thrown out the window. So it just feels like a good report isn't going to lock in that they're going to start cutting rates soon. A bad report could very easily sort of push that conversation out. So it feels like we're not going to get much good news this week, right? If best case things go according to script and we keep hoping for more good reports moving forward, worst case it looks bad and they sort of make explicit that we need more time and maybe rate cuts don't start until the end of this year or even next year. So
well, if Matt's right, 0.26, much more likely we hit a 0.2 than a 0.4. I mean, if it's a 0.3, that's consensus. But but you're right. If we go to 0.4 on the CPI, the core CPI, that I think that, well, maybe with good reason.
Right. Yeah. And so it just feels like we're in a no-win situation where a good report is still good, but it's tied to this idea that we need to keep seeing good reports moving forward. It doesn't really get us anywhere today. So
right. Well, hopefully Powell does bring up or somebody brings up harmonized inflation, and then I'll claim that I had some influence over the whole thing. There you go. The op-ed had some influence. Okay, well, very good. I think we covered a lot of ground. I need to eat my cereal, so I'm like starving. My blueberries and my cereal. Used to be on an oatmeal kick. Now I've got so sick of oatmeal. Now I've found this really great cereal, Great Grains cereal. Have you seen? Do you know what I'm talking about? I'm probably eating nothing but sugar, and that's why I like it so much.
But there's blueberries, so you're fine. Yeah.
Well, I always have blueberries.
You balance it out.
Yeah, blueberries and some raspberries. But anything else you guys want to add before we call it a podcast? No,
covered a lot of ground.
Okay, very good. Well, we'll do this next week. Well, thank you, dear listener. I really appreciate you listening in, and yeah, we'll talk to you next week. Take care now.